Securing a home in today's housing market requires intense precision. Buyers are competing against cash offers and highly motivated sellers, making an ironclad 21-day closing timeline a strict requirement to win a contract. This document is a formal commitment to on-time closing, backed by a $10,000 penalty for delays. It is built on an internal average of moving a buyer from application to clear to close in 21 days. That level of certainty sits in direct contrast to traditional lending procedures. Most lenders optimize for a single, heavily marketed metric, the lowest initial interest rate. Issuing a pre-approval based solely on that lowest top-line rate often ignores the underlying structure of a buyer's finances. This creates vulnerabilities, leaving the transaction exposed to surprises once the file reaches late-stage underwriting. Eliminating those surprises involves moving away from the standard product-pushing model. The Concierge methodology approaches mortgage origination as a holistic wealth management equation. Securing a deal in a competitive market requires shifting from simple rate hunting to comprehensive financial architecture. This slide outlines the mechanics of how rate-heavy lending can damage a buyer. Take the profile of David, a tech executive earning $285,000 a year who is attempting to purchase a $950,000 home in Atlanta. His parameters for success were specific. He needed to keep his total monthly payment under $4,800 while keeping his existing liquid cash reserves untouched. A traditional lender prioritized the absolute lowest available rate, pre-approving him at 6.125% with a 5% down payment. The immediate result of putting only 5% down was the requirement for private mortgage insurance. That added $380 in monthly costs, while his existing high-interest consumer debt remained unoptimized. Despite securing a low interest rate, the final monthly payment was $5,650. David exceeded his target budget by $850 every month. This financial strain created persistent monthly stress for the buyer. The high debt-to-income ratio resulting from the unoptimized loan structure nearly derailed the entire closing. Focusing on the interest rate as the sole indicator of a good mortgage can directly impact a buyer's actual monthly cash flow. Here, we see the strategy to rescue this profile. The concierge approach evaluates debt, equity, and cash before assigning a loan. The first maneuver leveraged David's home equity to increase his down payment from 5 to 15%. Reaching that 15% equity threshold immediately eliminated the requirement for private mortgage insurance. With PMI removed and debt restructured, we chose a higher rate of 6.375%, yet the total monthly payment dropped to $4,620. David saved $28,000 in long-term PMI and stayed under budget. This structural shift preserved his liquid safety net, allowing him to keep $95,000 in cash reserves while closing the home on time. Strategic adjustments across a borrower's full balance sheet can improve the final monthly cash flow, even when the interest rate itself is higher. Achieving this level of cash flow optimization requires pulling the underwriting stress test forward to the very first day of the relationship. This document outlines the three-pillar audit framework executed before a pre-approval is issued. Pillar 1 involves debt analysis, going beyond basic DTI to model payoff strategies that increase qualifying power. Pillar 2 evaluates equity and liquid assets to identify capital that can lower rates or bypass PMI. Pillar 3 audits cash and liquidity, tracking down payment sources and projecting post-closing emergency runways. A pre-approval issued without this deep analysis of the buyer's financial foundation is incomplete. Once the three-pillar data is collected, it is fed into scenario models to match the borrower's math with the correct loan product. This matrix shows how profiles dictate architecture. In Case 1, a surgeon had a 48% DTI due to high consumer debt. A home equity bridge loan cleared it, dropping DTI to 31%, qualifying him for a 30-year fixed conventional loan. Case 2 involves a cash-heavy entrepreneur with $1.8 million in revenue, but who lacks traditional W-2 documentation. The strategy here involved asset depletion formulas and bank statement products. This satisfied risk models while protecting the entrepreneur's business cash flow. Complex borrower profiles require bespoke structural solutions tailored to their specific financial data to reach the closing table. By identifying and resolving structural friction on day zero, the methodology addresses the specific financial triggers that typically cause underwriting surprises. This timeline breaks down the operational execution. Day 0 through 2 are front-loaded with the financial deep dive and loan structure design. Resolving these variables before pre-approval allows the file to move quickly through underwriting, with an average clear-to-close time of 21 days. For real estate partners, this means submitting offers backed by fully vetted pre-approvals that sellers can rely on. This methodology is backed by a $10,000 on-time closing guarantee, providing a financial safety net for both the buyer and the agent. Modern lending partnerships rely on restful elimination, structural expertise, and guaranteed execution rather than simple rate advertising.